The housing market has really hit the brakes. After 2 crazy years of skyrocketing home sales and surging prices, things have changed. A big part of the reason is that mortgage interest rates have shot up like crazy. It all started back in March 2022 when the 30-year fixed rate exceeded 4%, but it didn't stop there. By October of that year, the rate had climbed to a staggering 20-year high of 7%. Since then, it leveled off a little, but it's still hovering in the mid 6% range, which is definitely higher than what we've seen in the past. All of this means that home prices are starting to decline, and that's raising some serious concerns. With interest rates now more than double what we saw just a couple of years ago, and fewer buyers out there, it's no wonder the market has slowed down. It's a little concerning, to be honest. Is this slowdown an early warning sign of a major housing market crash? It's pretty much certain the real estate market is plummeting. It's not a matter of if, it's already here. Home prices are finally going down, affecting everyone and all types of homes. Some might even say it's worse than what we saw happen in 2008 during the Great Recession. The Case-Shiller Price Index tells us that the National Housing Index has already fallen by about 2.2% this year. Now, if you're thinking, oh, a 2.2% drop doesn't seem that bad, you're absolutely right. However, what's raising some eyebrows among experts is the crazy rate at which this decline is happening. It's projected that by the year 2024, things could look scary. Trust me, this is no joke. And before I get deeper into the real causes behind the housing crash, please take 2 seconds to help me out and hit the like and subscribe if you're enjoying the video so far. Each like and subscribe is fuel for the algorithm that helps support this channel. Thank you. Now, back to what I was saying. According to experts, the housing market will face some serious obstacles in the upcoming year. This is largely because high mortgage rates, inflated home values, reduced buyer demand, and a recession will all combine to create a volatile and challenging housing market. Selma Hepp, who is the deputy chief economist at CoreLogic, has expressed concern over the high mortgage rates that are currently in effect. She states that many potential buyers have been priced out of the market because of these high rates. In addition, the record low affordability of homes has made it difficult for many people to purchase a home without fear of the price decline. Many people who have bought homes in the past 2 years with ultra-low mortgage rates are unlikely to move anytime soon. This is because they have locked in a low rate and are unwilling to give it up. As a result, this puts additional stress on the available inventory of homes. Today's housing market isn't quite like the one that crashed in 2008. One big difference is that before the last recession, the housing market was booming because banks were giving out loans left and right without really checking if people could pay them back. People also thought that their houses would be worth more over time, making them feel good about borrowing more money. But that kind of thinking proved to be way too optimistic. Nowadays, more safeguards are in place to ensure that people are getting loans they can handle. And while there are still adjustable rate mortgages out there, they're not as popular as they used to be. With an ARM, you start with a fixed interest rate for a certain amount of time, but after that, the rate can go up or down. Right now, things are getting pretty complicated. The Federal Reserve is trying to increase interest rates to maximum potential, but the bond market isn't backing them up. And this is where things get really concerning. If we take a closer look, it seems like investors are starting to think that serious inflation might come our way soon. How do we know this? Just look at the 10-year Treasury yield. It's been steadily rising since early 2021. What does this mean? It means that investors demand higher returns on their investments to protect themselves against potential inflation. The 30-year yield is pretty much the same as the 10-year yield. This might sound complicated, but it's actually a huge red flag. If there wasn't any risk of inflation, then it would make sense for investors to choose the 30-year option with its predictably high rate. But the fact that they aren't doing that suggests something much bigger is going on. The reality is that there's just way too much uncertainty right now for anyone to confidently make such a long-term commitment. And this uncertainty is mainly driven by the fear of inflation, which could have a major impact on the housing market and potentially trigger a crash. Another important factor to consider is the return of risky lending practices. Lending standards were loosened to revive the housing market after 2008, and subprime mortgages were again offered. This has resulted in a significant increase in mortgage debt and a growing number of borrowers with high debt levels relative to their income. With rising interest rates and potential economic downturns, these borrowers are at a higher risk of defaulting on their loans, which could lead to a domino effect on the housing market. For example, if a larger number of people start defaulting on their mortgages, this could cause housing prices to plummet and potentially trigger another crisis. According to the Federal Reserve Bank of New York, mortgage delinquencies have been steadily increasing in recent years, which is a concerning trend that could contribute to a potential housing crash. Only 50% of American homeowners have at least 20% equity in their homes, meaning that a large portion of homeowners are more vulnerable to the effects of a housing crash. The 2008 financial crisis didn't come as a surprise to many. The culprit behind it all was how interest rates behaved over the past 30 years. Historically, interest rates have always been higher than today's rates. However, interest rates have been gradually decreasing over the past few decades. This decline in rates created the conditions necessary for the formation and eventual collapse of the 2008 financial crisis. Yet, it wasn't merely a matter of learning from our mistakes. In fact, following the 2008 crisis, the Federal Reserve continued to reduce rates to new historic lows, bringing them down to just 2.6%. So, around the end of 2011, a new housing bubble emerged in our country. Today, the true cost of owning a home has experienced a significant decrease when adjusted for inflation compared to the prices before the crisis of 2008. It's important to note that this type of trend has never been seen before in our history. And whenever we've seen something similar in the past, it has ended up being followed by a market crash. To give you some more background, a housing bubble is when housing prices quickly escalate due to high demand. People are willing to pay more for homes than they're actually worth because they have confidence that prices will continue growing. However, at some point, the market reaches a peak, and prices will inevitably fall. This means that people who previously purchased homes during the housing bubble will end up losing money because the worth of their investment drops. It can be quite alarming to think about how this type of market behavior affects our economy. Housing bubbles can result in an overall economic recession as the housing market is interconnected with other sectors of the economy. When people lose money on their homes and face foreclosure, it can create a ripple effect extending to other parts of the economy. The oversupply of luxury properties in certain areas is another significant factor contributing to the potential housing crash in 2023. In recent years, the construction and development of high-end luxury homes and apartments have increased, especially in major cities. This has led to an oversupply of these properties, making it difficult for developers to sell them at the inflated prices they were expecting. As a result, there could be a sharp decrease in property values and potential defaults on loans taken out of these developments. And guess what happens when many people default on their loans? Yeah, you guessed it. Another crisis. America is about to experience a tsunami wave of brand spanking new housing. Currently, roughly 1.7 million homes are under construction in the U.S. Can you believe it? That's the highest ever recorded. In 2006, the U.S. population ballooned by almost 3 million people annually. That's way too many people for the existing housing to accommodate, which led to individuals and families rushing to build new homes, further pushing up those construction numbers. Despite what occurred in 2006, the story is different now. Our population growth has slowed to around 500,000 to 1 million people annually. You might think that lower population growth translates to less housing demand, but that's far from the truth. Our world is ever evolving, and our living needs are changing, and we now require different types of homes. Mortgage rates seem to be steadily climbing, hitting over 7.6%. Meanwhile, the growth of the population shows no signs of significant changes. This begs the question, who will be interested in purchasing all these homes? It's a tough and worrisome challenge to tackle. However, it's worth noting that with increasing expenses, house hunting could prove to be a test of financial endurance. All in all, it's a troubling scenario for those in the housing market. With so many variables up in the air, it's hard to predict what will happen in the near future. Thanks for watching, and please make sure you subscribe if you enjoyed the video, and be sure to leave a comment below letting me know what things in your perspective seem challenging for potential home buyers, sellers, and real estate agents.